Hello, friends. Of late, the market is definitely looking a little weak. And if you've been following me on social media, particularly on our free Telegram channel where I put in most amount of our research, I have updated a couple of charts, especially the Bank Nifty, which has a double head and shoulder, which has bearish implications. I also put up a relative comparative return chart for the Nifty versus the Bank Nifty, which says that in the last 20 weeks, if you're a buy and hold investor in the Bank Nifty, you would have made more money by keeping your money in a savings bank account. Forget about a fixed deposit. That's the kind of return that Bank Nifty investors have had. Now, you're definitely worried that your stocks and your portfolio might just witness a certain amount of erosion. How do you identify if the stock that you own is going to fall? Now, in this video, I'm going to share 5 telltale signs that stocks might be vulnerable to a decline, and I hope this helps you. Now, basically, the best way to identify weak and vulnerable stocks are to identify where the buying or the buildup of long positions has been the highest. In the case of delivery stocks, you basically see the turnover in the cash segment and the percentage of the delivery of the total turnover that has been taken on a day-to-day basis. Where do you get this data? On the NSE's own website. The hyperlink to that link from where you download this data is in the description below this video as well as in a pinned comment. So I'm going to help you to get free data without paying a dime to anyone. Now, if at all the stock is in the FNO, even better, because now you not only have the delivery segment data, but you also have the MWPL data. What is MWPL? Market Wide Position Limits. This is the extent of total limits utilized by traders as a percentage component of the limits allowed by SEBI. The higher the MWPL, the bigger is the extent of emotional and financial buildup of exposure on that stock. Now, as long as the price is rising, bulls are happy. What happens when the price starts to fall? When price falls, you start to pay mark to market. You get calls from your broker saying, hey, I need more money to keep this position alive. These are called margin calls. Now, typically speaking, margin calls are one of the biggest reasons why traders are forced to liquidate their long or short positions. So, the higher the MWPL, the more likelihood of the stock turning against you. If you're long, it will fall faster. If you're short, it will rise faster because the buildup is big. And when traders are exiting big, huge positions, they are squaring up very large chunks of stock. That means the price movement is big. So, number one, stocks where MWPL is highest are the most vulnerable. Number two, even within the MWPL space, are two stocks with the same MWPL reading equally vulnerable? No, that's not, which is why you need to think a little ahead. If a stock with high MWPL is still trading above its month-long moving average on the daily chart, say a 20 or 25 day exponential moving average, the average signifies the average holding on cost, roughly, of a buy and hold investor. As long as the current market price or the LTP, last traded price, remains above the average traded price of a month, signified by a month-long moving average, you don't have a mark-to-market loss. So you're not worried. But another stock with equally high MWPL is constantly trading below its month-long moving average, which means your average investor's purchase price is higher and the LTP or the last traded price is lower. He's sweating. He's sweating under the collar, sweating behind the ears, and he's getting margin calls. Which one of the two do you think is vulnerable to a fall? I would bet that between the two stocks, The stock with high MWPL but trading below its 20 to 25-day moving average is more vulnerable to a fall. And do remember, falls are faster because bulls are tired, bears are shorting, and gravity is pulling prices lower. So, the old saying on Wall Street that markets climb up the stairs and fall down the elevator shaft applies here. The other thing is, if stocks are rising on very poor volumes but falling on large volumes, that itself tells you that there's distribution taking place there. Distribution would mean selling by smart money typically. The other aspect is how is the quality of the day's trade on rising days and falling days. If on a falling day, the range, intraday range of the price, the candle size, the bar size is bigger and the closing of the day is towards the lower point of the day. Now, there's a study called volume spread analysis. Those of my online family members who are familiar with VSA or volume spread analysis will instantly realize what I'm trying to say. If the price is making bigger candles on declining days and the close of the candle is towards the lower end of the day, volume spread analysis tells you that bears have been hammering and selling the stock till the closing price of the day. Compared to that, if the rallies are on smaller candles or on smaller bars, the range is smaller. That means it's just a relief rally, a dead cat bounce, a short covering rally, and what have you. So this is another criteria. The fourth criteria is the snap quote window. Now, this is something that I completely stress upon for my online family to learn how to read. There are more than 24 hidden signals on the snap quote window. Most of the trading terminals that you see in the Indian financial markets activate the snap quote window on desktop or laptop terminals by clicking on F5 after you highlight a security, or long press or double click on your mobile phone applications. You get 5 best buyers, 5 best sellers, open, high, low, close, ATP, average traded price, LTQ, last traded quote. Right? There's a whole lot of data there as well. Now, the snap quote window will basically tell you that the LTQ or the last traded quote is sustainably below the ATP or the average traded price day after day after day after day, minute by minute, hour by hour, whatever time frame you take. And the bid and offer spreads will be wider. The best buyer will be at 100, the best seller will be at 105. That wide. I mean, this is just a hypothetical example. Why? Because there's panic in the market. You don't want to get into, put a limit order which might get executed. You're scared, which is why you're putting very wide quotes, both as a buyer and a seller. Wide quotes, the difference between the buy and the sell offer, is basically a sign of panic, nervousness. Now, as a behavioral technical analyst, you need to get into the head of the other guy and think how he's thinking. That is how you can beat him, which is why we look at all kinds of data points. We do Excel sheets to measure MWPL. Those of you who attended my guest lectures at the NSE Academy or the BSE Training Institute, especially the Excel modeling classes that I conducted, I showed you how to create MWPL for individual stock futures day after day. The consolidated market-wide figure is something I put up on my social media accounts every single day, and you're seeing that. Now, so basically the LTQ will stay below the ATP sustainably. And the fifth and final data point as to whether the stock is going to come down, if it is in the FNO segment, are deeply out of money call options, OTM call options, adding exposure, which means that option writers who are very sensitive to return on investments could be writing deeply out of money calls because they know the price is going to come down and they will collect the entire premium as return on investment. The object being theta decay. Now, this very complicated jargonized terminology just basically means you're selling the option at a high premium with the objective that the premium will erode over time. And supposing you've sold the option at 5 rupees, 1 or 2 days before expiry, it goes down to say 50 paisa, you buy it back. So your profit is 4 rupees 59 paisa. Now that process is called theta decay. Don't get too intimidated by financial market experts who use technical jargon. It means nothing. As long as you can haggle with your vegetable market, vegetable vendor, if you can buy a kilo of tomatoes by haggling for the price, you're okay. You're going to be just fine as a good trader. You don't need rocket science here. So if deeply out of money call options are being written with the object of theta decay or to collect the premium, that tells you that smart money is betting that the price is going to fall. Now here is the last and final bit of evidence that you should be possibly either buying put options at lower levels, which is called tail risk hedge. The Mexican oil company Pemex does that every year. Deeply out of money puts, it buys at pennies, so that if the oil prices fall because they themselves are overproducing, they make money on the oil and on the deeply out of money puts that they have bought. So either you buy deeply out of money puts, or maybe you write deeply out of money calls, but that will be more expensive because you will be paying span margins and mark to market, etc. Or maybe, just maybe, you might consider getting out of that stock. I hope this video has helped you understand how to identify stocks that might be vulnerable to a crowded exit. Crowded exit is supposing you're in a cinema hall and God forbid there's a fire, you're told to exit and there's a big rush to get out through the exit door. It happens in the stock market as well. Let's avoid the situation where we had to head for the exit door in a crowded exit situation. Forewarned is forearmed. Let's stay ahead of the crowds. Thank you for your patience in being with me in this video. I hope you enjoyed this video. Let me know in the comment segment how you find our work here. Please help me reach smart traders like yourselves by sharing my work and subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts. And hey, let's be careful out there. Bye-bye.